Joining me to share his tech playbook, Doug Clinton of Deepwater Asset Management. Welcome back. What do you think Nvidia proved to us this week?
I think it proved that the AI bull market that we're in right now is not over. I know there's a lot of questions about the valuations of the Mag 7 and how quickly those valuations seem to have changed, at least how quickly those stocks have moved. But I think that what NVIDIA's results showed us, and a lot of Jensen's commentary, was that it still feels like we're pretty early in this AI bull market. That doesn't mean that we might not see pullbacks here and there as we go from what we think is a bull market now to what will inevitably become a bubble. I think it will take a few years. But I think that it kind of gave us a little bit of an all clear in terms of continuing to be excited about that AI theme.
So you would agree with some, like Adam Parker, for example, on the show, who makes the argument we're not even close to the end. In fact, we're barely past the beginning of this whole boom and what it's going to mean. And as such, you need to remain very heavily invested in these large cap plays.
I would agree with that. Depending on what analogy you want to use, you could say that we're in 1996 of the 2000 boom, if you want to equate it to that. Maybe that means we're in inning 3.5 or 4, something like that. But I think that that's the right perception. You know, we're still early on. Obviously, the market is starting to get the reality of how big AI is. So it's not in the very beginning, but I still think we have several years to go. The thing about the Mag 6, I'll exclude Tesla for this quick discussion, is that even though they've moved so much, I think people see this emotional reality. They look at the charts. They look at these mega cap tech stocks being up 50, 100% in the last year. The fundamental reality, though, is that they're not that expensive. I know Tom just mentioned on the last segment, Nvidia trades at about a 3% free cash flow yield. If you actually look at the average for the Mag 6, it's about 3.5%. You compare that to 4.6 or 4.2 rather on the 10-year. For the best companies in the world, that's just not egregiously expensive.
Sure, but they're not all Nvidia, right? Maybe we also learned that this week with what happened with Palo Alto. Now, how would you assess what that lesson is to be learned, if any, from the way that stock ran up into the number and then the way it plunged from it?
I view that as sort of separate from the AI discussion, and it really feels, I'd say, idiosyncratic to Palo Alto. The issue there was really the strategic change that they've made, and I think on top of that, we've kind of had 2 or 3, or I think 2 out of 3 rough quarters here in a row. And it just feels like there's more concern growing about the forward growth opportunity for the company. So anytime a company comes out and talks about changing the way that they're going to market, in the case of Palo Alto, kind of offering more free products, trying to get more customers in the door, and then ultimately land and expand, I think that raises questions for investors, and they're probably going to have to show that this new strategy will result in the kind of growth that they've talked about over the long run in the next couple quarters before I think people get really excited about the stock again.
That makes sense to me. I'm also not trying to suggest, that Palo Alto is some great, AI play. But if you look at let's say the euphoria, how it's being represented in the market, I would go 1A, AI, 1B, in many respects, cyber, right? Those stocks and the way that Palo Alto and some of these others ran up when everything theoretically was going up, whether it's software, cloud, AI, is that cause for concern to some degree?
I think it depends really on the companies that you're invested in. So one that we own, CrowdStrike, we still think that they have a pretty long runway for continued growth. If you think about cyber as an industry, why has it had such a bid, maybe similar to AI, not quite as aggressive? I think the reason is that because as we go into this AI age, cyber is going to become a more important part of every company's infrastructure spend. They have to protect whether they're doing training on models, whether they're running inference on models. They have to make sure that they keep that data secure. That's a cybersecurity application. And then on top of the AI opportunity, we also have a persistent tailwind of, I think, increased global turmoil. So these companies, I think they reasonably do have this strong tailwind from emerging AI, from the global tailwind, where you could argue that they should be able to grow 10, 20+% a year for the next 3 to 5 years.